Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Dan Dicker, author of Oil's Endless Bid, returning to the program. Dan, thanks a lot for coming back on.
Thanks for having me,
I
Mike.
really wanted to have you on because of the gyrations we've seen recently in the oil markets. I think the last time you were back here, we were up near recent highs, multi-year highs at, I think, around $114 a barrel.
In the TI.
Right, in the WTI
In Brent,
contract.
it was $15 higher, 131 or 2.
Right,
yeah.
right. And then we've seen a pretty decent pullback, back down to almost, I guess, in the low 90s on WTI. Market seems to be stabilizing. Now, recently, we heard some talk out of Saudi Arabia. The Saudis threatened that they were going to raise their daily production up to 10 million barrels per day in July. Now, that level, if they were to actually achieve that, we haven't seen that. You have to go back to the early 1980s, and I still think it was probably just a little bit under that. That would be a very high level of output for Saudi Arabia. Do you take that as a credible threat?
Well, first let's go back to the early 1980s. We want to talk about. Remember that global demand is about 20 million barrels a day less now than it was less then than it is now.
Right.
So in fact, getting to those levels, that 10 million barrel a day threshold, is not really as significant, for example, as what was being pumped by the Saudis in the 80s. So that's number one. The second part of your question,
it would it would represent probably an addition 1.5 million barrels a day
Easily.
from current production.
Easily
Okay.
from the Saudis. The second part of your question refers to whether this is to be believed or what the Saudis are actually planning. And to me, it's all a load of hooey. I mean, the Kabuki theater that we saw in Vienna 2 weeks ago
At the
was
OPEC meeting.
At the OPEC meetings, exactly, where there was a big story running around. It was actually leaked before the meetings began that all of the members were ready to agree to production quota increases. And then, in fact, you got this wonderful little theater, parlor game that went on when, Naimi kind of runs around Vienna and the CNBC anchors kind of follow him around and ask him questions, and he's all cute and happy. And then as the meeting breaks up, the Iranian and the Venezuelan ministers come flying out of the room in anger, and they run into their cars and they speed away, and Naimi comes out and describes the meeting as the worst they have ever had. Now, this is, to me,
all predictable. Yes.
Entirely predictable. In fact, the markets predicted that. They were rallying throughout the meeting, despite the fact they were talking about production quota increases.
But it was a good short to sell into that.
It was an excellent short for the reason that I think that this is the last time that OPEC may be able to get away with these kinds of theater productions on meetings where quotas, in fact, are never adhered to anyway.
Right.
This has always been. We have a demand picture of about 87 or 88 million barrels a day, depending on who you talk to. But what is being pumped out, or at least what is being registered as pumped out, is about 81, 82 million. Well, where's the other stuff coming from?
But it's always been the case that the other members of OPEC, the outside of the Saudis, they've always cheated and produced at their maximum capacity, and they've left it up to the Saudis to be the swing producer to adjust production either up or down. The question is, do the Saudis, like I've heard that the Saudis have maybe an additional 4 million barrels a day of excess
That's about right,
capacity.
depending on who you talk to. I mean, some oil analysts will tell you that the swing barrels, what they talk about spare capacity inside OPEC and specifically Saudi Arabia, is anywhere from 3 to 5 million barrels. Now, one of the things that came up over the last couple of months was this loss of production from Libya and the specific promise from Saudi Arabia to replace that production into the global marketplace. Now, that didn't happen.
No, not completely.
No, in fact, not even partially. And from what we can tell, very little more Saudi increase came on the back of the Libyan disruption. In this case, where we had this OPEC kind of meeting fall apart, and then everybody screaming about how terrible everything is, and then the Saudis saying they're going to increase production to take up the slack in terms of global demand. Again, I think it's going to be one of those things where they promise much and deliver little. This is, to me, as much as people want to guess about the OPEC cartel falling apart, is part of the theater, the production that they continue to do to try and keep prices as high as they possibly can so their members stay as happy as they possibly can.
What about the, now I've heard, and you could look at it, I think, as really a battle going on between the Saudis on the one hand, and Iran. And I think the Saudis are very concerned and worried about Iranian influence in the region, perhaps Iran getting a nuke. And the Saudis maybe see it that they have some ability to inflict some pain on Iran through the oil price, through an economic channel, if you will. And we've heard talk of the Saudis wanting oil in the $70 to $80 a barrel range. You know, if they want to, it's feasible that they could put it there. They do set prices at the margin by virtue of their ability, that spare capacity that they have.
They haven't touched quotas since 2008. When obviously we had the deleveraging in the oil market and oil fell into the 30s. And that's when they readjusted, obviously, down the quotas that in terms of what's being pumped. Again, these quotas are nothing. They're really just a theater trick. They're a parlor game in order to give some idea to some of the analysts of what exactly is going to come out. Now, the Saudis, I think you're right. They have a certain, they have a desire to be a little more conservative, a little more Western thinking in terms of the oil market, in terms of providing the kind of supply that might keep the price from rocketing again into the $140, $150.
They have to understand that a high price at some level really hurts economic activity.
Not only hurts economic activity, but in fact may generate a counter move on alternatives faster than they may want. You know what I mean? This is a country that's on the verge of trying to pass a natural gas bill, for example. A first step maybe in a wide-scale conversion of this country from crude into natural gas. Now, the Saudis obviously don't want to see that happen all too fast, even if they think it's inevitable. And one of the things that will make that obviously move with some acceleration is with oil prices at $150 a barrel as opposed to hovering around 95, or even better for the Saudis, around 85.
Now let's talk a little bit about, you and I were discussing how the benchmark in crude had always been WTI, okay, the U.S. contract. But now we're starting to see a shift towards Brent. And you were mentioning that a lot of the big Wall Street firms now, if they put out a recommendation on oil, it's based on the Brent price. We're starting to see more trading move towards Brent. And in fact, the Brent WTI spread now has really been blowing out. Is this a temporary thing? Is this like something we should come to expect?
People should first understand how ridiculous, from a physical point of view, it is for the Brent benchmark that's traded on the ICE and cleared in London compared to our WTI, which is traded at the NYMEX, part of the CME, and cleared here and comes out of Cushing,
Ridiculous
Oklahoma.
In one
Here's the point. The grade of WTI is what's called a sweet grade of crude. So is Brent. But the sweet grade of crude that comes, the West Texas Intermediate sweet grade, is a lot easier to be refined than the Brent product is. And therefore, it's usually more expensive because it's an easier product to use for refineries to turn into gasoline and heating oil, jet fuel, and all the other byproducts that we get from crude oil. Now, to see a price of Brent go over WTI even a little bit is usually a financial disconnect that we used to see when we were trading it very, very infrequently. But it used to happen. Somebody got stuck on a position or spreads. You know, so there could have been a physical problem in one of the markets that could cause something like that. To see a long-term trend of Brent, $10, $15, $20 over West Texas Intermediate is more than just, you know, a run-of-the-mill financial disconnect. This is, to me, it's one of the most striking examples of where all the speculative money and all the interest in crude oil is going and what it is and how it's feeding into Brent and out of WTI. Now, the reconnaissance on that, if I can go back for a second, is with Goldman Sachs at the start of this year in 2011 deciding that they were going to take their benchmark product for crude index speculation called the GSCI and move it from WTI and move it into the Brent contract. So we call that a rebalancing. That's what they call it. I call it shifting where all the speculative money goes. So there's a rebalancing number one, of the largest commodity index in the world from WTI into Brent, number one. And then you find that over the course of the last several months, when recommendations come out from Paribas, from Goldman Sachs, from Morgan Stanley, from JP Morgan, from everybody basically who trades oil for a living and gives out recommendations to clients, is in that Brent contract and no longer in WTI.
A lot of people don't even realize the influence that this kind of rebalancing can have, that the influence of Goldman just saying now, okay, we're going to base this on Brent as opposed to WTI, and how that sets in motion a whole chain reaction of huge institutions, pension funds, whatever, having to shift, into a different contract.
Exactly. In indexes alone, there's about $350 billion of money attached to commodity indexes. Now, in the GSCI, about 70% of that is directed towards crude and its products. So that's a lot of money that's running to chase the oil barrel. Now, there are some physical constraints on WTI on the Cushing side. There's no doubt about it. But those physical constraints do not equate to a $20 differential between something that should be cheaper.
Let me ask you, could it also have anything to do with regulation or expected regulation that U.S. contracts coming under the regulatory, of the CFTC?
Absolutely. I mean, that's one of the reasons that Goldman moves to rebalance into Brent, because they know from their own experiences with Dodd-Frank and some of their prop trading in other desks how regulation might impact their trading in this, and they are trying to avoid that kind of problem down the road, although it's not there yet, obviously, for their clients and for themselves in terms of crude oil trading. And so they're moving into a contract cleared in London, outside the United States, where there might be less effect on regulation down the road.
All right, I just want to get quickly your outlook for oil for the rest of this year. Where do you think we'll hit?
Well, I think we're on the bottom. We're on the back end of one of these, the mini boom that we saw up to 113 in the TI, 130 whatever in the Brent. I think that the summer is going to require a little settling back. But what happens is that we create a higher low than we had in 2010. 2010 we got down to 68. This low, I see it somewhere between 82 and 87.
They call this,
and that's going to be the silver lining of this soft patch. Okay,
yeah,
that we're
said
going
an
to get
oil price collapse.
An oil
we're
price
talking
collapse.
90.
But we're talking about a higher low again. And again, what you have is if you make one of these higher lows, then when the next leg up comes, which I believe doesn't start until the fourth quarter in 11 and into 12. That next spike up doesn't go to 130, it goes to 150 or 160, and we're back where we started.
All right, good stuff, but probably scary stuff for the economy.
Unfortunately.
Dan Dicker, thank you very much. Dan Dicker, author of Oil's Endless Bid. This is Mike Norman. That's it for now. We'll see you next time. Take care. Bye-bye.